Okay, good morning. We are in the afternoon. Good afternoon, everyone. Please confirm that you can hear me clearly.
Good afternoon, Mr. Wasi.
Good afternoon,
Good
sir.
afternoon. Good afternoon, sir.
Okay. All right. You're welcome to class. Today, in our first period, we are going to look at sustainability and integrated reporting, which is around, at a minimum, is around 10% of our syllabus. So we're going to finish it in our first period. In the second period, we are going to look at presentation of financial statement. I'll start with IS 1. Then we're going to transition into IFRS 18 that will commence in January 2027. So you need to know about it. So we will no longer have IS 1. It will now be replaced with IFRS 18. So those are the two things we're going to cover today. So as soon as we cover them, I'm done with my class for today. So let's start with what we have in front of us. Sustainability reporting. So the first thing we want to know is what is sustainability reporting itself? The, the common definition that we have about sustainability reporting came from a report, and it's we generally define sustainability itself as developing in a sustainable way. And when you're developing in a sustainable way, this definition says that it says it's a development that meets the needs of the present without compromising the ability of future generation to meet their own need. So in achieving whatever an entity wants to achieve in the present moment, meet your needs at the present moment. Do your transactions, do your productions, but don't compromise the ability of future generations to meet their own needs in the future. That is sustainability. So it's usually defined in the context of sustainable development. So the discussion we're going to be having will be discussed based and applied to businesses. So as a reporting entity, we expect them to operate sustainably. We expect them to develop and evolve sustainably. How they do that and how they report those there are ways in which they have developed sustainably is exactly what we want to look at today. We're going to look at the process and all of that. So for a business, when we say sustainability, we're talking about running an enterprise in a way to create your value for the entity itself and the stakeholders without depleting the environmental, social, and economic resources upon which those values ultimately depend, which is similar to the earlier definition I've given. That as a business, you should create value. You should create value for your stakeholders. But in doing that, don't deplete resources, environmental social, and economic resources. Don't destroy the environment. Whatever it is that your business is, make sure that you're not depleting the environment. If you are into woods, you are a carpentry business, that you go to forest to cut down trees, make sure you plant another one. So that's you're not depleting the environment. Irrespective of the business you're doing, don't deplete the environment. Social. Sustainability is beyond environment. Social as well. The people that work for you, don't drain them mentally. Don't cheat them. Don't prevent equal opportunities. Social. So don't deplete environmental, social, and economic resources that you are using to build your value. So those resources that you use to build your value, don't deplete them. So that's the whole idea about sustainability. And that's what we want to talk about today. So a business that's generating huge profit, but is degrading the natural environment that it depends on. It's messing up the environment that has created a value for it, or is not treating the community where it is making the money from, is not treating them right, or its employees is not ensuring their well-being is the way it should. It's not ensuring that they are healthy, no HMO. That organization might not be successful. That is what we are looking at. It means that that organization is not operating sustainably. So when we talk about sustainability reporting, it's just the practice of disclosing information about an entity's performance, risk and opportunities relating to environmental, social, and governance matter, alongside and increasingly connected to its financial performance and position. So when we say sustainability reporting, it means that then tell us, disclose information about how you have performed in relation to the environment. Tell us your impact on the environment, on your people, on the governance structure that you have put in place to ensure that your organization operates sustainably. Tell us the risk you're facing when you're trying to operate or develop sustainably, or the opportunities you have gained from all of this. So sustainability is disclosing those information about the impact that an organization's activities have caused on the environment, about your performance in relation to environment, your risk and opportunities in relation to the environment, social and governance matters. And in doing that, sustainability reporting as at today, you have to then connect that to your profits, to your assets, to your performance and position. So all you're doing when we talk about sustainability reporting, all you're doing is that you are communicating how you have created value, how you have preserved value, or how you have eroded value over time. When you report about your sustainability activities, your performance in relation to the environment, the society, your governance, all you're doing, you are just explaining to us how you create value, right? Because by then you'll be telling us the resources that the environment has provided to you. You'll be telling us how you have preserved those values. What actions are you taking to ensure that you don't deplete the environment, the natural resources, the natural environment, the social well-being of your people and your community, the internal governance structure that you have in place. That's what you'll be telling us. So sustainability is you communicating how you have created, preserved, and eroded value over time. Now, when an organization do this, why is this even important? Why do they have to do this? Because businesses, as you all know, is out there to make profit. They consummate transactions, they make profit. Why are we now bringing in issues around ensuring that they develop sustainably, ensuring that they communicate information about how the activities, how they have performed, the risk they are facing, the opportunities they are facing in relation to those environment, social, and governance issues in such a way that we then now know how they are creating value, how they have preserved and eroded that value. Why does this matter? We categorize this into three. Okay. Why sustainability reporting matters? We categorize it to the entity itself, to investors and lenders, who are the primary users, and also to the society and the environment. See, when an organization reports about its sustainable development, about its activities on the environment, what it does to itself is that it will then be able to identify and manage risk that can actually affect its ability to even continue as a going concern, whether regulatory, whether physical or reputational risk. Because by the time you are conscious of your activities on how it affects the well-being of your staff, you might be identifying some reputational risk. Because if you're not conscious of that, there are some actions you'll be taking that are detrimental to your going concern. But you'll be able to identify those early. If you are conscious, if you are reporting those your impact or physical risk. You see, there are some activities that can cause natural disaster, that can cause sea level overflowing, that can cause a lot of natural incidents that human effort might not be able to avoid. But when you report about your activities, your performance, risk and opportunities relating to this environment, you might be able to deter them before they crystallize into financial losses. So ultimately, when an organization identify this risk early, it will help them lower their cost of capital because investors' confidence will be increased that this entity is thinking about the future. So they can easily invest at even a lower cost. The interest they require from them will be lower because they become a trustworthy entity. And of course, it helps the organization itself to plan for the long term because management would then be able to think systematically about the risk and opportunity beyond the present moment. Because it's thinking about what is my activity, what's the impact of my activity on the environment? How have I destroyed am I destroying the environment? What's the impact of my activity on my people? The way we are operating now, are we taking care of our people? Are we ensuring equal opportunity? Would these people want to work with us for the long term? Right? Sustainability reporting ensures that. So, in a way, it supports better long-term strategic planning for the organization. That's for the entity. To investors and lenders, it helps them provide information because the investor will now have information from the reports the entity has provided now. Investors have information that can help them to assess that this company will continue to make money, that they will continue to make money because you have already identified the resources, the opportunities the environment is giving to you, that we are an oil and gas company. We have an OML license. This is where the offshore, whatever, where we extract the mineral resources. And this, we have identified it. And this is exactly what we're doing to ensure that these resources, we don't deplete it, and also we don't destroy the environment where we are operating. We don't, because we are extracting oil in this field, we then don't think about the community. One day the community can revolt and cause problem for us. But when we report this, it shows that we are conscious about our continuity in that field. And the investor, from the report they are reading, then knows that this company, with the way they are operating, money will continue to flow. Money will continue to flow. So the investor, it makes the investor know and assess that the money this company is making is sustainable. It's something that they will continue to make into the foreseeable future. And to the society and the environment, it shows that the organization is accountable, right? And it's taking record of its environmental and social footprint, and is making it publicly available, because you are going to be telling us about your performance regarding the environment and the society. You're making it socially, um, it's publicly available. So you see them asking this kind of questions severally. You always find this in the exam. Okay, why sustainability reporting? The benefit of sustainability reporting. From these, you can get almost 5 points. Looking at how it benefits the entity itself, the investors, the society, and the environment. Now, in our discussion, there are some terminologies that I've identified here. Number one is, I've mentioned sustainability and I've explained it very clearly. Now, what we are looking at here is that ensuring that an entity meets its present needs without compromising the ability of future generations to meet their needs. We have defined that above. And typically, the focus of sustainability is in three areas: environmental, social, and governance factor. So these are basically non-financial factors that are used to assess an entity's performance and risk. Okay. And the environmental factors are matters such as emissions and resource use. Okay. Majorly, maybe carbon emission. That carbon dioxide, and the way and manner in which they use the resources that nature has provided to them. That's environmental. Social factors cover matters such as labor practices and community impacts, while governance factors covers issues such as board oversight and business ethics. Okay, do they have proper structure? Are they conscious of it as an organization? Do they have somebody responsible on the board that, guy, you are the one in charge of sustainability, to ensure that we track our environmental factors, social factors, and governance. So that's governance. And so when we say ESG, you will hear about ESG. That's what we call sustainability now. Report that to us now. That's sustainability. As we move on, everybody here already knows or have heard about materiality. For sustainability, there's something we call double materiality. Because here, everybody knows that an item is material for our traditional financial reporting. We say an item is material if its omission or misstatement will affect the decision that user make on the basis of those decision. Then on the basis of that report, then we say that item is material. If you misstate or omit it, it will affect the decision that user want to make. The same thing applies here too. When you're reporting about your performance and risk relating to the environment, relating to the social, the society, and also governance, we expect that the items you would present and disclose are items that are material. So materiality, we looked at it on two bases. We have impact materiality, right? Impact materiality is where your activities impact the economy, or if it impacts the environment or the people, right? So looking at materiality based on impact basis, you are not looking at figures or amount. We are looking at the impact, the effect of your activities on the environment, on the people, not the entity. Okay? And this is the basis applied by GRI. You will learn about that later. The one that we use in financial accounting is financial basis. So we look at materiality from the impacts that it has on the cash flow, the profit, or the position of an entity. So if that impact is material, then that's looking at materiality from financial basis. We can also look at it on impact basis, not looking at it financially, but on the impact it has on the people, on the environment. So if it is significant, then we say that's material. So we're going to look at, we need to be used to that as well. Also, we're going to learn things about physical risk. Physical risk. So as part of the impacts of an organization activities, one of the risks that can occur is a physical risk. And a typical example is climate change. Okay. When our activities affect nature, it can bring about a lot of natural changes in the physical structure of the environment. Okay, like there could be, let's say earthquake, for example. That's physical risk, right? And when there is earthquake, the impact of earthquake is that maybe it could damage the asset of an organization, right? Maybe it could render their asset unusable anymore, that they cannot use it. So we are talking about the physical effects of that, your lack of sustainable development, right? If the climate should change, what are the physical effects it can have on the entity? That's physical risk. And we could also have transition risk, right? So this one is different from physical risk. We are saying that transition risk is the how the way we respond, the way we respond to a change in climate, for example, whether the government might come out with a new policy that because of this change, then all companies will start paying tax, like a carbon tax, it could be technology, and because of climate change, and there could be changes in technology that might render a product obsolete. It could be changes in demand, market response. People might just don't want to use your product anymore because they believe that the way you operate is not sustainable. So why physical risk looks at the physical effects of a climate change, of a natural change in environment, the physical effect. Transition risk is the response, market response, environment response, people's response to those changes, right? It could be either policy response, legal technology. That's transition risk. We're still going to mention it earlier. Also, we're also going to hear things like greenwashing. Okay. So you hear organizations because they have said you should present about your sustainable activities, how you have been treating your performance relating to environment and society. Then we might have a situation of greenwashing where organizations are now presenting their performance in a more favorable manner than it is. They could overstate the underlying fact. They could lie. They could present things they did not do, right? That's greenwashing, saying that you're green when you are not, right? Also, we're also going to see the six capital also, which which evolve beyond just financial capital, which we use in traditional reporting, our share capital, which is just financial. We would also see things like manufactured, intellectual, human, social, and relationship capital, and also natural capital, right? That organizations use to create value. I can't count the number of times I can have asked this one. They'll just ask you, please and explain the six capitals in sustainability reporting. 5 marks. 5 marks. It's something you are going to talk about, and also assurance. Okay. Assurance is like the same thing like the audits that we do for financial reporting. Okay. So assurance means independent verification of the information we report about our sustainable development. That assurance. So these are terms that I'm going to be that I'll be talking about. So the very first of them, which I've mentioned slightly, is physical risk and transition risk. So this constant in this area, and this is something you need to understand very well because when it comes to the environment, these two risks are things that are very present. Physical risk, like I mentioned, is a risk from the climate itself. Transition risk is risk from the way the world responds to that change in climate change. So, while physical risk is about the weather, how the weather change, how the physical environment change, the other one, which is transition risk, is talking about how we respond, the new laws that we bring, the new taxes, the new technology, the changes in customer demand that happens, right? That's majorly um, transition risk. So I okay, I gave some differences between the two further in case it's asked in the exam, so you're able to, in a simple manner, explain to them that for physical risk again, this basically deal with the physical effects of a changing climate, if there's a risk, changing climate, the physical effect. And transition risk is economic, regulatory, technology, and market response to a climate change. So it's how we respond. That's transition risk. So for physical risk, these are examples of it. Like flood, a cyclone, a chronic long-term shifts in sea levels, whatever it is, changes in the environment that is adverse to humanity and to the entity itself. But transition risk, we're talking about maybe they introduce a new tax, there's a new technology, people are not buying the product again. That's majorly transition risk. So when you have physical risk, the accounting consequence is that it can damage your assets. It might requires that you pay more insurance. It might also require that you pay more maintenance costs, and it can disrupt your operations. That's physical risk. When there is a natural disaster, these are things that will happen. Your assets, it can even shorten the useful life of the asset. But when it comes to transition risk, where the world respond with a new law, with a new tax. So, meaning it can affect the future cash flow from that asset or that product line, right? Or there will be new compliance costs, or the asset can even become economically viable before the end of their physical life. Okay. So, an example is you have a warehouse beside the coastal beside the sea, for example, a coastal warehouse that could be threatened by a rising sea level. So if the sea level rise, it can overflow that warehouse. I mean, it's just an example, just like a core Atlantic in Lagos State now. If the sea level should rise, there's a risk that it can wipe them out. That's a physical risk. Okay. Or for transition risk, if you have a coal-fired, like a power plant that is emitting huge, huge carbon dioxide, a coal-fired power plant, it can be affected by a new policy. The government might say that don't use that plant again because what is emitting is too much into the atmosphere. So it might require significant cash flow outlay from the entity to invest into a clean energy. And that can affect its future cash flows. And that's what basically we are actually talking about so far. So good. Now, having mentioned all of this, now let's talk about where we are today and where we were coming from, the progress from ESG to sustainability reporting. So before it used to be ESG, 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 but now we have transitioned to sustainability reporting. We started it has been on since the 1970s, where people were being conscious about the society and environment, or how entity are impacting it. So you find organization talking about it. They are majorly voluntary disclosure and majorly narrative. They just talk about environmental impact and community involvement. So there was no structure whatsoever. So in the next decades, in the 1990s and 2000. So ESG reporting became investor focused in the sense that investors were becoming more green. Investors were only investing in entities that are socially responsible and environmental conscious. So that's where ESG reporting emerged properly. But again, there was still no structure, but at least it was becoming investor focused and investor driven. So in the early 2000s, late 1990s, then frameworks were coming up. There were NGOs like the Global Reporting Initiative. It's the very first that it was launched in 1997. It's a framework. When I say framework, we mean an approach to reporting, sustainability reporting, or ESG reporting. Okay, so GRI were teaching people how to report that through these frameworks, and later the Sustainability Accounting Standard Board came up in 2011 that also came up with its own framework as well. It came up with materiality and how people should measure their impact on the environment and all of that. So it was becoming popular. Now, by 2020, um, sustainability reporting became decisive in the sense that it moved towards mandatory. We're coming from voluntary reporting. All these GRI and SASB that came up in the early 2000s, they were still voluntary. People were just reporting it. Now it became mandatory, and there is now a standardized way of sustainability reporting, which culminated in the establishment of the International Sustainability Standard Board and the issuance of the first two standards in June 2023, which Nigeria has adopted anyway. So from this period onward, sustainability is now becoming to be converged with financial reporting in terms of its structure and enforceability. Okay, so look at it. So that's the trend. We moved from voluntary to mandatory, right? People were just disclosing it. People were investors conscious. Investors are saying if you're not operating sustainably, if you don't see it in your books, you won't invest in you and all that. There were voluntary frameworks like GRI and SASB that came up with how people should report their impacts, how they should measure it, metrics and targets, how they should measure it, the targets they can have. Now, what we have today is a mandatory reporting of sustainability or of sustainable development. As it is in Nigeria now, by 4th January 2027, the mandatory reporting will commence for entities in Nigeria. We're going to get to that place. So that's how we transitioned, how we moved as far as sustainability is concerned. Now, sustainability, does it have impact on the financial statements and also on disclosures? Of course, yes. So, we often think that sustainability is something that we put in the notes or in disclosure at the back of the annual report, that it is disconnected from the figures that we have in the financials. But the reality is that many of the sustainability related risks, they have direct and quantifiable impact on line items in the account. So for example now, if you look at items like provisions, okay, some of these provisions are arising from environmental and sustainability related obligations because I've not taught you IAS 37, but I will teach you IAS 37 that an entity is expected to make a provision when there is a present obligation arising from past event and which will result in an outflow of economic resources and which the entity has to settle, and they can reliably measure it. You see, issues around sustainability, like the physical risk I mentioned, for example, or even the transition risk. So sustainability and environmental matter, they create this kind of obligation where an entity will have to make a provision. So sustainability reporting is strongly linked to the financial statement itself. That the line item in the financial statement is as a result of reporting on sustainability. So it has serious impact. It's they are interwoven. So I gave an example. This example I gave you will be more meaningful when I teach you instead some, but let me just look at it with you. So there is a mining company. It constructs an extraction facility at a cost of 2,000 million, that's 2 billion. And under environmental legislation and consistent with the company's own published decommissioning policy, it is obliged to dismantle the facility and restore the sites once mining operations cease in 15 years. Management estimates the future cost of this restoration at 450 million in 15 years' time. If they discount it to its present value using an appropriate rate, it will give an initial provision of 180 million. Okay, so these are sustainability issue arising into the entity making an estimate of future obligation, which they have to pay. So resulting in them making a provision of 180 million. So when I teach you IFRS IS 37, you see that that 180 million will be recognized as a liability or a provision immediately, and there will be corresponding debits to the cost of that facility itself. The costs of that facility will be depreciated over the useful life of the asset, but the provision is not static. The provision will be increasing through time, through unwinding of discounts over time. So I'm going to teach you this better. What I'm just trying to show here is that sustainability really do have an impact. When you're reporting on sustainability, it's linked to the financial statement, not only provision, also impairment of assets also. I've not taught you IS 36, neither have I taught you IFRS 9, but you are going to learn that when an asset recoverable amount is higher than it's higher than when an asset recoverable amount where it's not up to its carrying amount, okay? In that case, an entity would be required to make an impairment loss. They would have to impair the asset, right? And looking at transition risk that we mentioned, see, when an entity is faced with a climate change and market response is adverse in the sense that is a response whereby people change demand, it can affect the future cash flow of the entity. It can affect the recoverable amount from an entity's assets, which will result in the carrying amount being higher than recoverable amount, and whereby they will have to impair the asset. So impairment loss, you might see it in the books and think, yes, we have done the accounting, but it's actually being triggered by sustainability activities, by an entity's impact on the environment. That's why it's arising. And I also gave an example here where a power generating company owns a coal-fired power plant with a carrying amount of 2 million. New government climate policy, which is a clear example of policy and legal transition risk. It introduced the carbon tax and mandates a phased reduction in coal-fired generation capacity over the next 10 years. Management revises its cash flow forecast for the plants to reflect three consequences of this policy: declining output as capacity is progressively phased out, additional carbon tax costs on the output that remains, and a shortened economic life for the plant overall. Discounting these revised cash flows give rise to a value in use of 7.5, which management determines exceeds fair value less cost to sell and therefore used as the recoverable amount. Now, since recoverable amount is now less than carrying amount, that means there's an impairment loss of 1.5. So 4.5 might be triggered by sustainability reporting. That's why we are calculating impairment loss. I also gave one more example on changes in useful life, which is driven by physical risk. I explained that a change in climate can result in a physical risk, which is the physical effects that changes in climate would have on an entity's asset. In such cases, it can shorten the useful life of an entity's asset, which will result in changes in useful life and also the resulting depreciation that you calculate on that asset. So it really does have effect on the numbers in the financial statement. And I gave some examples here as well and some summary. In furtherance to that, beyond sustainability reporting having impact on line items in the financial statements, also in the notes, narrative reporting for disclosures also, sustainability impacts those as well, because narrative reporting, it covers qualitative forward-looking or items that are not yet quantified as far as sustainability reporting is concerned. So, but we can disclose them in the financial statement as part of our notes. Okay, so in the notes, you see the entity disclosing them under their strategic report and management commentary. So in disclosures, you see entity, the director's report, for example, right? They would, in their strategic report, you see them talking about their business model, their strategy, their principal risk, the uncertainty that they face. You see them in the notes, in the disclosures, or in the narrative section of the audited report. It's usually the beginning before we get to the notes part. Also, they talk about principal risk and uncertainties that they face. Also, you see in the chairman's statement, he will talk about the total macroeconomic environment of the entity, their sustainability ambitions, their strategy, also in the director's report. So these are places where you would see organization. So sustainability reporting definitely do have an impact um on the financial statements. And it's critical, like we have mentioned, because by the time user looks at this, it comes in as an early warning. People are then aware about risk that an entity is facing that can affect their ability to continue to operate as a going concern. And I did a little extract here of how the report, of how they actually talk about it. This is from a financial statement under the chairman's report. of statement. It talks about that climate change presents both physical and transition risk to the group's operation. The directors consider that a sustained increase in temperature in the group's principal sourcing regions could reduce crop yields among key agricultural suppliers, which will result in increasing input costs over the medium term. The group is evaluating alternative sourcing strategies and does not currently consider this risk to have a material effect on the carrying value of its asset, but continues to monitor the position closely. So this is how you would find it in the financial statement, like that. Okay, so that's looking at sustainability reporting as it impacts on the financial statement. And also, when it comes to disclosing sustainability reporting, now we have a standard which I would talk about in detail later. Okay. You see, we are talking about the impact, how sustainability impact the financial statement. It's more structured. They don't just write it anyhow anymore because now we have two standards on sustainability reporting. So before it was historical, it was voluntary, it was unstructured. They just put it as a separate section. But with the IASSB's standard on sustainability reporting, it's now a more structured and formalized way of reporting sustainability issues, which we're going to look at in later section, and we'll see how it works. So it's better reported now. And finally, on sustainability impact on the financial statement is approach to reporting called integrated reporting. Okay, so this is an approach to reporting. Now, with sustainability reporting, a lot of organizations now, the way they now report is integrated. So they integrate sustainability reporting into the financial statement. So that's what we call integrated reporting. It's an holistic approach that combines financial and non-financial information into a single coherent report. And it will then show how the six capitals that I mentioned earlier, how they interact with another to create value for the organization. Okay, the six capitals: financial, manufactured, intellectual, human, social, relationship, and natural capital. So it's a lot of organizations that report sustainability uses this approach. They integrate their sustainability activities, the disclosure of sustainability activities into the financial report, and they show us how the six capitals has helped them to create value over the short, medium, and long term. And again, this approach to reporting was introduced by they have a framework, they call it International Integrated Reporting Framework, which was issued by International Integrated Reporting Council, but they are no more. They don't exist anymore because they have been merged into the IFRS Foundation. The IFRS Foundation are the guys in charge of IFRS. They are the one that controls the ISB. Okay. So they were merged with IFRS Foundation in 2022. Right. So is now placed alongside with the mandatory disclosure standard. So integrated reporting framework is principle based, just like the IFRS. It's just an approach to reporting where an entity should sustainability reporting and financial statement integrate them together, and also explains the concept of the six capitals. So the focus of this integrated reporting is just to, in fact, the framework central concept is value creation, right? Take us through the process by which an organization's business model takes input from the six capitals. It transforms them through its business activities and produces output and outcomes that will in turn increase, decrease, or transform those capital over time. So an integrated reporting tells that story. If you pick a Dangote report, just like we don't have the luxury of time, I will have shown you Dangote reports, and since 2020, 2019, does this. It tells that story. It shows you that process. You will see a Dangote report will tell you that process, that these are our business model. If you check their report today, tell you these are our business model. These are the capitals that we use. These are our activities. This is what we have created. This is our output. This is where we operate. They would show you that story, how they have transformed the how their business model takes input from all the capitals and using their business activities produces output where value are created. So it showed you that it shows us that connects, right? That's incredible reporting. So instead of presenting financial result and sustainability information as separate, disconnected section of an annual report, it connects it together. It connects it together. So the six capitals I've been mentioning, these are these are very simple, straightforward definition of them. They have asked it, they could ask it in the exam. So first one is the financial capital. So when you say financial capital, it means the money, the pool of funds available to the organization that they obtain through financing or that they generate from their operations. Okay, like equity and debt or revenue or retained earnings. So they use it to produce goods and provide services. Beyond that, there is also manufactured capital, which are manufactured physical objects available for use in production, like factories, equipment, road, and buildings. I mean, without roads, a lot of productions will not take place because how will raw materials get to the factories? How are you going to move goods? So manufactured capital is critical, right? Integrated reporting wants you to explain that it's not, you just gloss over it as if it does not exist. They are capital. They help us to achieve organization's objective. There is also intellectual capital. There's also intellectual capital, which are organization knowledge-based intangibles, like their patents, uh, like their softwares, their their licenses, the brand name they have created over time. Is their intellect, what they have been able to build, and they have patents on them, their softwares. Also, human capital, their people, the competencies of their people, their capabilities, their experience, their motivations to innovate, right? As a result of the trainings and leadership developments that they have built into them. These are capital too. There is the social and relationship capital, which is the institutions and relationships within and between communities, the relationship that they have with their customers, the government, the community is also a capital. If an organization have good relationship with the government, that's why you see a Dangote that is at any point in time during election, he always position himself towards the likely winner. At the very beginning, he'll be moving to left, he'll be moving to right, moving to. By the time he sees that this is the guy that is winning, he will quickly. He's trying to build his relationship capital because a single government policy can change the trajectory of his business. It will change everything for him. Also, there is natural capital, which are the environmental resources, right, that enable an organization to be prosperous, like water, mineral resources, air, land. I mean, different shapes and forms of resources that exist, biodiversity in the universe. So they really help organization succeed. That's natural capital. So, and this one integrated reporting says that you should talk about when you are preparing your reports. Don't just focus on financial capital alone. Don't just focus on the number. Tell the story about how this capital, the input you get from this capital, how your organization processes has transformed this into outputs. Tell us the story. Show us that process. That's integrated reporting. So it introduces a way of integrated thinking. Okay. So integrated reporting is, yes, you tell the story, but integrated thinking is internal, is inherent within the organization. That does that relationship exist? You can report and say this, but does it really exist within your organization? Does that is does that connectivity exist between how you use the capitals, how you integrate them in decision making to output level and all of that, which is what integrated reporting wants to introduce for organization. So integrated reporting is not the same as sustainability reporting. They are different. So sustainability reporting, whether you are using GRI or SASB or ISSB standards, as we are going to learn, what it does is it can stand as a distinct report where you explain the impact of your activities on the environment, social and governance issues, right? That's into sustainability reporting. But integrated reporting, what is a different dimension entirely. What integrated reporting is doing is saying that it's an approach to reporting where you're going to report your sustainability activities, your financial activities, report them into a single coherent account of how you have created value over time. Let's see it in a single document. That's what integrated is, an approach to reporting, right? That's bring everything together in a single document for us. Okay. So I've been talking for over 1 hour, 1 hour to be specific. So I can see you're asking a question. Yeah, can you articulate this? Let's hear another voice.
Hello, sir. Hello, sir.
Yeah, hello.
Yeah, hello, sir. Please, could you throw more light on that six capitals as regards to sustainability reporting?
Okay.
Yeah, could you throw more light on that six capitals?
All right, I will. I will throw my light on it. But I would love somebody, any one of it, to speak to that, just to be sure that you are following us. Yeah, okay, go ahead, Candy. Okay. Yeah, so as requested, uh, now these six capitals is emphasized under integrated reporting. So, like I mentioned to you, integrated reporting is an approach to reporting where an organization is encouraged to present both their traditional reports, which is what we have been learning how to present an annual report, integrate your sustainability reporting within them. And in doing that, make sure that they flow. It has to be a logical, coherent flow of events. So the way it encourages that, it acknowledges that there are actually six capitals, not just one that we are used to, which is the financial capital, which is the pool of funds, the money that we get from financing or from profits that we have made over time. Okay, which is financial capital. It's identified other forms of capital as well, like manufactured capital, which are the roads, like the infrastructure that enables production, factories, equipment, bridges, buildings, and all of that. To intellectual capital, which is the patents that we have, our brand name, license that we get from government, our softwares. These are intellectual capital. To human capital, the competencies, capabilities, and experience of our people, our employees, the motivation that they have to innovate, the trainings and leadership. These are human capital. And also social and relationship capital, which are the goodwill that we have built or trusts that we have built with our customer. If customer trusts you, it's a capital in itself. Community goodwill is a capital in itself, right? Or you have good suppliers relationship or good government relationship. It is a capital. These are social and relationship capital. Or natural capital, the mineral resources that we have, the lands, water, air quality, all of these are capital. So integrated reporting is saying that acknowledge, explain all of these capital, how you have used them to as inputs into your business processes and activities, and how they have helped you to create value over the short, medium, and long term. That's the story that they want us to paint. So if you paint that kind of story, you'll be able to then identify how you have been depleting the environment, because the environment itself is a capital. Because when you are explaining, all of this capital already covers environment, it covers your people, which are social capital. So sustainability indirectly will be imbued. So it's just ensuring the organization acknowledges that these environmental matters, social matters, governance matters, they actually help to create value. So if you don't manage them properly, it can equally erode value for an organization. And that's what sustainability reporting wants us to do. So an organization should then think integrated to appreciate the fact that most of these things are not in isolation. They are actually resources, they are capital that helps create value for you within the organization. Don't think it's just the money you bring into the business. No, no, it's beyond that. Your people, the natural resources, the government infrastructure, they are also very important. Okay. All right. Now, let's move to, okay, Kendi, you are raising up your hand again. You can
Oh,
talk.
sorry, my network is bad. So I left the question.
Oh, okay, your network is bad, truly. Okay. So usually, you see, as we're going to learn later, to answer your question, organizations depend on the organization anyway, but most structured organizations have a sustainability officer, a chief sustainability officer. So when you check most of like AFS of MTN, for example, or Dangote, or most of these banks, they have a chief sustainability officer. They have somebody in charge of that. And who says the person cannot be an accountant? Can be an accountant too. So why we are learning it as accounting is because these environment matters, social matters, they can have an impact into our own report. So we really need to know about it. We need to push management of our company to be aware of it. And again, sustainability issues is not generic. It's not generic. It depends. As we're going to learn, we are not there yet. When I look at those standards, it depends. The impact company A has on the environment is different from the impact company B has on the environment. Okay. So what's happening to everybody's network today? Sandra too said that network is bad. My own network is not bad though. My own network is good. So any along that you wanted to say something. So let me open the
Yes, sir.
floor.
I wanted
So,
to.
so I'm opening the floor for comments for the next 3 to 5 minutes before I finish up. So any along that, please go ahead.
Yes, good afternoon. I'm actually looking at this just transparency reporting and integrated reporting. In, we have different types of company, or let's say different size. We have different size of company. So, um, this sustainability reporting and integrated reporting, are they required by law or for all companies, or there's a set of company or a size or some sizes of company that are required to provide these reports in their financial statements? Or that's what I want to. If is it something that they must, or they should, or they may, and the size of the company, is it determined by the size of the company, by law
Okay, good
or
question.
standard?
Yeah, so as at today, which we are going to look at it soon, it is not mandatory in Nigeria yet. So we have standards, we have structured standard, like I mentioned earlier when I started the class, for reporting, sustainability matters. Yes, sir. So for reporting sustainability matters. However, um, it will become mandatory from January 2027. It becomes compulsory. And they did not specify the size of companies. It's mandatory for everybody, right? That's sustainability reporting. So what integrated reporting is talking about here is just an approach that you can use to prepare your annual reports in a way that the sustainability matters flows naturally into your annual report. It will flow naturally. That's where the six capitals comes in, because the six capitals already talks about the environment, the people, and all that, which are basically what we want you to explain, how it has helped you, how you are depleting it. So, ingredient reporting, I mean, most organizations, if you adopt the IFRS S1 and S2, automatically you have to present your annual report in an integrated way, which is integrated reporting. Okay, but as of today, it's not mandatory yet, though we have early adopters that are adopting it yet, but mandatory adoption will start from January 2027. Yeah, shall I go ahead?
Yeah, good afternoon, sir.
Yeah, good afternoon.
So because I was actually going to, you've answered part of what I was trying to ask. It's still relating with this sustainability report. But the question I was going to ask before Enolonda asked this question is that if you are, now let's look at it holistically in Nigeria. For those of us who are conversant with what is happening in the Niger Delta, um, President, I think former President Buhari made some, effort then. I think 2016 or thereabout, I can't remember the year now, when he said that they should go to Ogoni land and they clean up the Ogoni land. So I was going to ask before whether if there's any authority or maybe regulatory body that enforces this, that at the end of the day, if you do not do what you are supposed to do as a company, you are extracting maybe crude oil or any natural or mineral resources anywhere in Nigeria. And what they normally do is we have report a lot of complaint here and there, so that Chevron, all these big oil companies, they will just go there and they will destroy the land and the economy activities of that area, like fishing and all of that, farming generally, they won't be able to do anything again. So I was actually going to ask whether if we have any regulatory body in Nigeria that enforces that. But it seems you have answered the question.
Okay, so you have raised a very practical issue. So, like in Nigeria now, those oil and gas companies that operate in the upstream, in the upstream sector, which is what we're actually talking about. So, of course, there is a regulator that is in charge of that, and there's a new regulation that came out recently that actually talks about all of this. So, companies cannot just go and destroy natural resources and all that. They are well documented. What's the name of this regulation? I can't remember it now. It's recent. In fact, Buhari signed it before he left. Right? Buhari signed it before he left. It's well documented. Right? So our own now, which is the area where Financial Reporting Council of Nigeria comes, where they come to play. Our own is just disclose information about your impacts on the environment, your impacts on your people. So it's just that disclosure of information that FRCN is really worried about. When it comes to the field, the operational arm of it, that's the regulator in that arm, which is the Nigerian Upstream Regulatory Authority, that are in charge of that. So there are regulations, there are regulatory bodies for that segment of industry. Okay. So, but our own is the sustainability reporting. Report those activities in your books as well, which is where FRCN comes in. Okay. All right. So I think I have to continue now because I've opened. Okay, go ahead.
So sorry, sir. I just thought about something. We do have social corporate social responsibility. In any way, is this sustainability reporting and integrated reporting, are they coming in to actually replace corporate social responsibility in a way, or to extend it? Because I'm looking at,
It's
okay, we've always been having corporate social responsibility, which some of the definitions and objectives or features of this new uh, new phenomenon uh, dictates corporate social responsibility as it were. So are they coming to either replace it or to extend or to eliminate it totally from our reporting?
replacing it. In
And
fact, it's
recently,
now
okay, and recently we got some set of people in our company. They are called internal control over financial reporting about a month ago. So they came for just to audit our processes in totality, our processes. So is is that part of this sustainability reporting or integrated reporting we are talking about?
so that one is different. So ICFR is a new introduction from last year by FRCN, introduced for public interest entities to also report on their internal control. So, and it's not the auditor that will do that, it's a separate set of people that will come in for assuring that your internal control over financial reporting is effective. So that's internal control and it's over financial reporting. That's quite different from sustainability reporting. It's different. Okay.
Oh,
Good
hello,
questions.
sir.
Yeah, please. Yeah, hi, love it.
Thank you, sir. Please, who are the regulators of this sustainability reporting and the foundations? How is it FRS, sorry, IFRS
FRCN.
or IFRS?
Okay. So I would get there, but in Nigeria, we have the FRCN that is in charge in Nigeria. However, if you remember, when I taught you regulatory framework, we talked about IFRS Foundation. So internationally, the guys that develop the standards as of today, they are under the IFRS Foundation. We call them the ISSB, International Sustainability Standard Board. They are the ones that are responsible for developing standards on sustainability reporting. But in Nigeria, we have the IFRS, we have the Financial Reporting Council of Nigeria. Okay. All right, good questions. So let me use the next 30 minutes to round up on sustainability, to quickly look at other areas that are also critical for the exams. Then I'll look at, because I still have to look at past questions so that you would understand that these are very important areas of your exam that you can easily make 15 marks or 20 marks or more in the exam, or it's something you would find often. So let me quickly use the next 30 minutes to do that. Then we can discuss further so that by 5:30 I'll be done with this. Then we can move on to the next thing. So the next part of your syllabus says that you should be able to explain the factors that are responsible for increasing demand for sustainability reporting. Why are people interested in it? So I segmented it into 3 factors. One was international factors. As a result of this, the following point I give here. International factors, because of investors are now demanding it, as they want to, is something they are considering before they allocate capital to companies. They want to see that this company is operating sustainably. Also, there are a lot of regulation in the Western world, in Europe, right, which gave rise to the International Sustainability Standard Board that we have today internationally. So all those are also coming up, and is what is putting pressure or making people or entity want to report about their sustainability matter. Also, climate change. Everybody can see it, that climate is changing. So physical risk and transition risk is then becoming a reality. So it's also resulting in this increasing demand. And stakeholder capitalism. Now, everybody is not just only shareholders now that are expecting information from company. Everybody, the community, the employee, the environment, they are interested in what organizations are doing. And beyond all of this, organization also wants to protect their reputation and brand. So since all organization, international companies are presenting sustainability, they also want to present. They don't want to be left behind. Beyond international factors, there are also local factors that are specific to Nigeria. In Nigeria now, we have the FLCN, which is now being mandated to ensure companies in Nigeria adopt the ISSB standards. And they have come up with a roadmap, which I will show you very soon. Also, there has been sustainability disclosure. There has been guidelines on sustainability disclosure that has been issued by the Nigerian Stock Exchange for companies that are listed. Also, Nigerian company needs to access international capital. And since their foreign peers are already disclosing sustainability, so they also want to disclose it also. Even the CBN is not left behind. They have introduced sustainability-linked initiatives. So all of these are putting pressure. All of these are what is resulting in increasing demand for sustainability reporting. Now, there are problems and limitations to it. Number one is historical lack of standardization. Before the standards that we're going to discuss, before they came out, we had multiple competing frameworks. People don't have a way to present how their activities have affected the environment and people. So, resulting in a sustainability report that is incoherent and incomparable. Also, is difficulty of measurement. How do you even measure your impacts? How do you have sustainability metrics? How do you measure your impact on the environment? Is also a limitation. And also there is the issue of greenwashing. How do you even know that the company is telling the truth? Yeah, you see companies saying that they have done this, they have done that on the environment. How do you know they are telling the truth? Another one is the cost of compliance. To present sustainability reporting require that you collect data about your impact. That's money. That's also there. Also, sustainability reporting is forward-looking and is more of strategic. It's not just present alone. So there will be significant estimates that will be made, and that would affect faithful representation. Also is independent assurance. Unlike traditional reports, the way auditor will come in and review the reports, we don't have that here. There is no independent assurance. We just rely on what the company has disclosed. Again, there is no reporting boundary. There is no defined reporting framework yet. So people can just report to any length and breadth. So those are limitations that actually do exist. Now, you need to also be aware, because they can still ask you, historically, the first framework that came out, the first body that came out with a framework was the Global Reporting Initiative and also the SASB. So you need to understand their principles and contents, how they work. Because even till today, the ISSB standards really solidly relied on these two to come up with the standard for sustainability reporting. Now, the Global Reporting Initiative, the way it works in a way that organizations should consider its impact on the economy as a whole, on the environment as a whole, and it should consider how its activities has impacted on all stakeholders. So GRI is the broadest and most widely adopted sustainability reporting framework in the world. It has universal standards which apply to all organizations. It has sector standards which applies to individual industry, and it has topical standards that deals with issues like greenhouse gas emission, labor practices, water use. It's segmented into that end. And the way it works, like I mentioned, it applies the concept of impact materiality, meaning that it considers the impact of the organization's activities on the entire world. It's not about financial impact. It's not about the entity, it's about the environment and people. Impact materiality. And it expects the entity to report to a broad range of stakeholders, not only investors, but also employees, local communities, NGOs, governments, all stakeholders. So GRI is community-centric, world-centric, it's not entity-centric. But the SASB standards that came out, that one is investor-oriented, and it concerns itself specifically with financial materiality, how the entity's activities on the environment affect the entity itself, affects its enterprise value, that are only relevant to investors. So also the SASB consists of industry-specific standards. It covers 77 separate industries. And it recognizes the fact that sustainability issues are different from each industries. it applies the concept of financial materiality, not impact materiality. So you see it only reflecting sustainability information that would affect the entity's financial condition, not the people. So it looks at that, this thing you're doing, it will affect your ability to continue as a going concern. How does sustainability matters affect the organization? That's how it looks at it. So its primary aim is investors and capital market participants, not the broader universe. Not the broader universe. So as of today, SASB was integrated into Value Reporting Foundation, which itself has been merged into IFRS Foundation in 2022. So all of those are not, SASB does not exist anymore. It has been merged, though its work is still alive. They are using it. It's still there. They are still maintaining it. But that body itself has now ultimately become IFRS Foundation in 2022, which gave rise to ISSB. So the body in charge of sustainability reporting now is the International Sustainability Standard Board. So I can ask, I think a long time ago they have asked this before. So you need to understand how GRI works and how SASB work, because the way SASB work is now the way ISSB, that's the line ISSB is flowing into, because that's where ISSB originated from. And it is the standards that ISSB developed that they are now evolving now. So all of these things I've said, I have summarized it for you in this table, which you can carefully look at. So under GRI, under Sustainability Accounting Standard Board, the way this one looks at materiality, this one looks at it as impact, the organization impact on the wider world. SASB looks at it as financial materiality, the impact of sustainability matter on the entities and its environment and its investors. So this considers the impact on the investor. The GRI primary audience is broad range of stakeholders. The other guy, SASB, is investor. GRI standard is structured around universal and top sector and topical. SASB basically structured its own standard industry specific and focused on 77 separate industries. As of today, GRI is still independent, okay, though it's now also working with ISSB, but SASB has been merged into IFRS Foundation that has now become the International Sustainability Standard Board. So it's worth looking at. Last diet or last two diet, this was the one they asked, the emergence of ISSB, because what we have today now is the ISSB, the International Sustainability Standard Board. That's what we have today. And like I mentioned, this board was established by the IFRS Foundation at the 26th United Nations Climate Change Conference that was held in November 2021. And this is in direct response to the fragmented sustainability reporting landscape that we used to have, where we have GRI is talking about something, SASB. So ISSB came to pull everything together. Let's have a single framework. So its purpose is to develop a comprehensive global baseline for sustainability-related financial disclosure standards. And of course, it's built with the same rigor and discipline as for that we have for IFRS. Okay. So when they established the ISSB, the IFRS Foundation consolidated the technical work of three separate bodies. We have the Task Force on Climate-Related Financial Disclosures. I think this was in the Europe. Value Reporting Foundation, which is the SASB. And they also incorporated, which by then, of course, the SASB, and also the Climate Disclosure Standard Board. So the work of these three was what they brought together to use as orientation for how the ISSB would work. So as of today, as of June 2023, they have issued two standards. Okay. And entities are supposed to start reporting using these standards from January 2024. So I kind of asked you that you should talk about this, the emergence of ISSB. So you need to be able to tell us this sequence from how they were developed in 2021 to their purpose, to the bodies that made it up, and to the standards they have now issued. So I then did a summary of differences between, please give me 1 minute. Okay, so I did a summary also for ISSB, which is the new one now, and these two old ones is almost the same as what I've done earlier on, just to give you a snapshot of their focus from their materiality. ISSB to is financial, ISSB and SSB is the same. So this one is impact. This looks at on the people, the audience, their connects. Just is something I've mentioned before that you can easily look at. Now, the standards, the two standards that they brought in, they asked these last diets. They asked you to do some definition last diet around this. So the scope, conceptual foundation, objectives, and core content of the ISSB standards. So the objective of these two standards is just to disclose information about sustainability related risk and opportunities that is useful to the primary users of general purpose financial reports to enable them make decisions about providing resources to the entity. If you remember, this is exactly the same as chapter 1 of the conceptual framework. If you remember, so to provide information about a reporting entity that is useful to potential and existing investors, lenders, and other creditors to enable them make decisions. That's chapter 1 of concept. This is the same, just that this one is disclosing information about sustainability related risk and opportunity. So that's the objective of those two standard. And it talks about conceptual foundations. So this is also similar to the qualitative characteristics that we talked about under conceptual framework. So here it talks about fair presentation. So meaning that whatever it is that you are disclosing should faithfully represent the entity's sustainability related risk and opportunities. Materiality, only material items should be disclosed, not everything, material item. So, and remember, ISSB's focus is financial materiality. Okay. And also connected information. Makes the sustainability disclosure should be connected to related information in financial statements, which is where integrated reporting actually comes in. So I also mentioned double materiality. I've already explained this. So when it comes to sustainability reporting, since GRI is still in existing, which focuses on impact materiality, where we will say a matter is significant or material if it affects the people. If it affects how it affects the people and the environment. While financial talks about how it affects the entity's cash flows and performance and position. So we call that double materiality. So it's just worth acknowledging. And I did some examples explaining impact materiality and financial materiality. And what I was talking about there is that if a factory, for example, is using the water in the community and the water either is not available anymore or it's being contaminated, it's going to impact the community. That's impact materiality. But does it have financial materiality? Will it affect the cash flow of the entity? Can the organization get alternative and all of that? Of course, yes. But can the community get alternative? Maybe no. So that's double materiality, considering the impact on the environment and the entity, right? Why single materiality, which is financial, we only look at does it affect the organization? And that's all that really focuses on. Now, this one is also another important part. The way the sustainability standards are structured and developed is developed around these four content areas. So, and they have asked this before too, if I remember vividly. They have asked this before too. So they are developed around these four areas. And what are they? One is governance. So when you are presenting your sustainability report, tell us about who is in charge in your organization. That's governance. Second is strategy. Tell us how you are identifying the risk and opportunity. How? What's the model you're using to identify how the sustainability related risk and opportunities that you are faced as an entity? You tell us about your risk management. Do you have a robust enterprise risk management? Have you incorporated this sustainability related risk and opportunity that you identify under your strategy? Have you incorporated it into your enterprise risk management? How do you intend to manage this risk? How do you intend to ensure that it does not affect the organization? And also its metrics and targets. How do you measure? How do you measure your impact? What are your targets? How do you intend to reduce your impact on the environment? What's the target that you have? When do you want to do this? So this is the way the information that is required to be disclosed under sustainability reporting. This is how it should be structured. And that's how the standards are actually structured on the information that are required. So the first standard, okay, which we call IFRS S1, okay, we call it general requirements. It's a standard that talks about general requirement for disclosure of sustainability related information. Okay, general requirement. So what the first standards came with, it came with a general requirement for disclosing sustainability related risk and opportunity that can affect the entity's cash flow, access to finance, and cost of capital. So it does not cover a particular area of sustainability, but it's a general area. It's a general requirement. And the key requirements in that standard are you should disclose all material sustainability related risk and opportunities, not just any area that your organization impacts the environment. Disclose all of it, whether water scarcity, human capital management, labor practices. And you need to remember that sustainability is not just about environment, it's also about social also. So disclose all material sustainability related risk and opportunities. Also, ensure that the information are linked to the financial statements. And also tell us, faithfully represent it. Don't tell us what does not exist. Don't tell us what does not exist. And you need to disclose this information exactly when you are presenting your financial statement. They should be inside it. It should not be separate. It should not be separate. And of course, you can use industry-based standards or guidelines as developed by the SASB. Okay, so the first standard, that IFRS S1, specifically requires entities to still apply those old standards from SASB. Okay, and present it in a way that we can compare it with your previous year reports. So when you present sustainability information this year, it should be comparable with that of previous year and going forward like that. The second standard, that one deals with climate-related disclosures. That one is more focused on climate. And this one it works hand in hand with the first standard, just that this one is not specific to climate. And the way it's structured, it talks about the climate-related risk that we have talked about earlier on, both the physical and transitional risk, and also talks about climate-related opportunities like resource efficiency, adoption of low emission energy, development of new products or services, access to new markets, or building resilience against climate-related disruptions. These are climate-related opportunities that changes in climate can bring to companies. You can make them develop new products in response to climate change. You can make them adopt low emission energy sources and all that. And the requirements of these standards is an organization should carry out scenario analysis on these climate-related risk and opportunities. Look at different scenarios under which this climate change can impact the organization. Don't just, you need to have a strategy around it. Look at different scenarios. If it goes this way, if it goes that way, look at different scenarios. Also, disclosure of greenhouse gas emissions. So this is basically talking about if you disclose, if you emit carbon dioxide, you need to disclose it. And disclosure of emissions is in three ways. Is either is a direct emission from you, from the generator that you use in your factory, from the company's vehicles and all of that. So those are direct emission. And there is indirect, we call that scope 1. There is indirect emission, which is scope 2. That's the one from if you buy electricity, for example, or you buy any products that you're using. The fact that you are buying it, okay, the emission from the people that produced that electricity. For example, now you buy a cloud storage, for example, to host your websites. You are saying, you are using cloud computing. But don't forget that the people that are selling it to you, they have a data center that as big as 12 football fields. They will emit carbon into the atmosphere. That's an indirect emission for you as an organization. Even though it's not directly coming from you, it is also related to you because you're encouraging it, you are buying from them. And there is a third category, which is also other indirects, which is scope 3. So this scope 3, it could either be upstream or downstream. So other indirect is the one that arises from either your supplier. So you buy raw materials for you to use in your factory. You buy raw materials for you to use in your factory. So if those your supplier that you buy it from, if they are emitting carbon dioxide, that is also related to, you need to disclose that also. So it's scope 3 is other indirect. If you yourself, you eventually you produce your goods, you sell it to your customers. Your customer are using those goods. If from the goods they are using, they are also messing up the environment, um, resulting in rising sea level, emissions, and all of that, is also related to this because you have sold product to them. That's why they are impacting the environment. That's scope 3 is an indirect emission for you and your organization. So it's part of what this second standard is actually talking about, disclosure of greenhouse emission. All this I'm explaining, I gave you some examples that you can look at, and I did a complete illustration for you to understand better this direct, indirect, and other indirect. So if you look at this, you're going to be able to explain it. So also there is the transition plans as part of this climate change, which is this for the second standard. So entity must also talk about how they intend to move into a low carbon business model. If they are emitting high carbon, they want to move, they need to have a climate transition plan. Also, you need to adopt an industry-based metrics. This has to be disclosed as well. How do you measure? How do you measure your emissions? You need to have climate metrics on how you capture um, what you're emitting exactly so that you are disclosing the right amount. Also, there is internal carbon pricing. So some organizations usually they place a penalty. So there is internal carbon pricing. There is a price on emission that, okay, if you emit this certain amount this year, would would include a cost in our books. That's a cost. It will be a cost for us. It's an internal carbon pricing. There's external too, but that one is government tax, like a carbon tax. Some organization will have an internal pricing framework just to discourage and ensure that they emit what is low. They will capture it as a cost. On a final note, is they are also working on another standard. Okay, but it's not a standard yet. It is at the level of exposure drafts. Okay, so what's that new standard will talk about is nature-related disclosures. Nature-related disclosures. So the second standard talk about climate. The new standard will talk broadly beyond just climate alone. It talks about nature related, it talks about biodiversity, the ecosystem entirely. It's more robust. So they are still working on that. And entities need to watch out for this and see how it's going to affect them. So it's going to change a lot of things. And also, they are also making updates to the second standard. that they have. They are doing some updates to how to include greenhouse gas emission, how entities are going to measure it, particularly the one that has to do with the product that they sell to customer, what those are emitting. How are they supposed to capture all of that? So it's very difficult. It's part of the limitations anyway. So that is happening right now. So I talked about arguments in favor of usefulness of climate-related risk and opportunities, which is similar to advantages of sustainability reporting. It enhances investors' decision-making. It improves long-term predictive value. It supports comparability across entities and sectors. And it drives behavioral change. And these are the disadvantages. There is estimation uncertainty to determine and measure the emissions. Your impact on the environment is very, very difficult and uncertain. Also, comparability is still a challenge, even though it's been standardized. The risk of greenwashing, the cost-benefit question, and the assurance is not there yet. There is no independent assurance, is not mature yet. So in Nigeria, the Financial Reporting Council of Nigeria has adopted this roadmap. From immediately, they have adopted these two standards. So they have a roadmap. So they categorize companies into four. They have the early adopters. So these ones are companies that would adopt the two standards from 31st December 2003, from period ending 31st December 2023. These are early adopters. So they can start adopting it. And there is the voluntary adopters, which will adopt these standards from period ending on or before 31st December 2026, which is this year. And there's the mandatory adopters, which is the period beginning on or after 1st January 2027. So by 1st January 2027, it becomes compulsory in Nigeria. And there is the public sector entity. So for this one, the timing will be communicated by FLCN at a later date. They have not informed us. When they are ready, they will let us know. So there is this readiness document that has to be submitted to FLCN. So these three documents must be submitted 3 months before the beginning of when you're supposed to start reporting sustainability matters. Number one is a board resolution approving the adoption of this standard. So there has to be a board resolution. The company also needs to submit a gap analysis report where you identify differences between what the company is doing and what the standard requires. And also, they need to submit an implementation plan setting out how the entity intends to close those gaps. Also, after no more than 3 months after you have started the reporting date when you're supposed to start adopting, you're also supposed to submit these additional documents. One is the entity sustainability disclosure policies. Also, identification of transition reliefs. Also, the entity's enterprise risk management and sustainability framework. Also, evidence that the board has approved the disclosure policies. Also, evidence that the board has approved the entity's risk management. And also, evidence that they have trained people that are responsible for these disclosures. You need to show evidence that you have trained them. And finally, no more than 6 months after the beginning of this, when you're supposed to adopt, there has to be evidence that the entity itself and its professionals are actually registered with the FRCN, and you need to provide a description of the models used by the entity for scenario analysis. Also, need to identification of sustainability related and climate related risk and opportunities, and also evidence of establishment of a governance structure in place. And finally, is target and metrics set by the entity to manage and measure the risk and opportunities it has identified. So all of this document has to be provided. So, and there are other three: identification of the aspects of the entities report that requires updates, and also identifying current and anticipated effects of sustainability related risk and opportunities, and a description of the internal control the entity has established over its sustainability reporting. So ICANN has not really asked this area, so it's a potential part. So, and I also, what I did here is just to give you an example of how sustainability report is prepared. Okay, I just did an illustration. So usually the report is usually structured along those four core contents. That's how they structure the report. So governance talk about the people in charge. Strategy is how they have identified the risk. Risk management is how they have integrated it into their risk management framework. Metrics and target is how they measure it, and the target they have to reduce their direct and indirect emissions. Okay, so it has been asked severally what we have talked about, like last diet now at skills level. We're asked to define all this: value created, eroded, and preserved, reasonable and supportable information, connected information, fair presentation, reporting entity, risk management. So out of these six, discuss any five. So it's part of what I've discussed. So I've done the solution for you. So you can use this note to read that up. Also, in November 2025, they also asked it. I think these are the professional level. You can ask it in any of the levels because it's the same. We're asked to discuss key features of sustainability reporting, objectives and benefits of sustainability reporting, explain the importance of the activities of IASB to global sustainability reporting, 15 marks. So I've done the solutions for you here, which you can also go through. Also, in the same November, you have been asked to advise the company on the potential benefit and challenges of adopting this sustainability reporting standard, which is similar to just benefit of sustainability reporting and their challenges. So I just put benefit of adoption. But since they say write a report, so anytime they say prepare a report, just do a report for them from to date subjects. So you put the benefits because the mark is just how many marks? 5 marks. So you can do 2 benefits, 3 challenges, or you can do 2. I just did 3. These are things we have discussed, and also the challenges. Also, I think this is May, this is not November. In May 2025, they said you have been asked to advise the company in the oil and gas industry on the implication of exposure. Okay, the exposure draft I talked about, that nature-related disclosure that they are introducing. How is it going to affect the implication of it to a company in the oil and gas industry? Also, how can this company apply the concept of multiple capital? So we are going to talk about the 7 capital. And also we are asked to discuss the emergence of IES SSB. So it's usually 15 marks in the exam and it's an area I feel you should. So this, I also help you put the solution here consistent with what you have learned today. So this is the summary of everything and further guides for you for your exam. So it's a wide area, right? And it's an area that you just have to take your time to look at it. You have to take your time to look at them as they are particularly um, relevant for your exams. It's something that is, you find them in section C, and they are even moving something that is frequent. So last diet, for example, at SBR, it wasn't asked, but you are going to find them asking it this diet. So this document I given you has the past questions. I've summarized most of the details that you need to know. So just have to make the effort to go through it. It's important. Is important. A 15 marks question is important. I don't know whether you understand how important that is. The kind of energy when I start teaching you IS 16, IS 38, and those other standards, you can sit down on them for a whole day reading it. And those ones, they are like maybe 2% of the syllabus or 1%, because it's just one standard. Okay. This one is 10%. So you can sit down on this one to a whole day and read it consistently until you are used to most of these things that that we explained today. Okay, so that is it for sustainability, and that's the end of our first period. We overused our time in this first period because the discussion took longer than I didn't know I'm going to take this long on this area. So uh while you can stay online. Let's take a 15-minute break. Then we'll come and start this new topic, which is IS 1. This will not take us, I'm not sure it will take us 1 hour to finish. We would quickly discuss that. So
Thank you, sir.
let's come back by 6:15. I'll start up by 6:15. So just rest your head and let's get ready. So I'll see you guys later.